Gold is approaching a major liquidity zone, and this is exactly where smart money is preparing its next move. My primary focus today is a potential sell setup directly above key liquidity, but there's one specific condition that has to happen first.
Let's get straight to the point. Our directional bias right now is strictly bearish. The ultimate draw on price is the sell-side liquidity resting between 40.20 and 39.95. However, our primary mandate at this exact moment, we wait for confirmation. Section 1. The gold trading opportunity. Immediate directional bias. While most retail traders are actively looking at the exact wrong level right now, the market is sending us a severe warning signal. Just look at this M15 battlefield. The rapid price action and displacement you're seeing here, that's not random market noise. Institutions are currently rejecting that 41.10 to 41.20 area, signaling that they're engineering price to target something completely different beneath the current consolidation. Section 2. Today's executable trade plan. Key levels and targets. Before we break down the complex institutional order flow driving this market, you need the exact executable game plan. My current bias remains bearish as long as price trades below the 41.18 threshold. The primary sell zone we're stalking sits specifically between 40.75 and 41.05. And if we get that entry, the primary objective is a macro liquidity sweep, targeting the equal lows resting near 39.95. Section 3. The smart money target. Institutional order flow. Let's look at exactly why smart money is engineering price to attack these specific liquidity pools. What we're seeing are powerful volatility catalysts meeting structural targets. We have the hawkish FOMC rate hold between 3.5 and 3.75%, combined with the geopolitical strikes in the Middle East. Now, for retail traders, these are terrifying headlines that cause emotional panic buying. But for institutions, these events are strictly algorithmic mechanisms being used to engineer liquidity and distribute short positions at a premium. Zooming out to the daily distribution phase, the institutional footprint is glaring. Notice the macro markdown phase from those previous 5,500 peaks. We have a pristine sequence of lower highs and lower lows, driving price aggressively into deep discount arrays. The daily structure remains entirely in a distribution phase. But here's the problem. While the overarching macro trend is bearish, this specific, massive pool of sell-side liquidity resting just below the 39.98 equal lows changes everything. It acts as an incredibly heavy magnet for algorithmic price delivery. Section 4. Real ICT trading scenarios. The if-then logic. Let's remove all emotion and ambiguity and lay out a hard, executable plan. Here's the exact sell scenario we're waiting for. Step 1. We absolutely must see a sweep of the buy-side liquidity between 41.10 and 41.25. Step 2. Following that sweep, we require a clear M15 bearish market structure shift, proving institutional sponsorship. And step 3, we enter only on the retest of a newly created fair value gap between 40.75 and 41.05. Breaking down the institutional risk to reward for this specific setup, we'll utilize a hard stop loss above the 41.25 liquidity sweep high. We aggressively take our first partial profits at 40.35 to secure capital and remove risk, leaving a final runner for that ultimate 39.60 macro objective. As of right now, the current status is no trade. Smart money confirmation has simply not appeared yet on the lower timeframes. If these exact structural conditions aren't met, there is no setup. We don't gamble. Institutional footprints are a strict requirement for entry. Section 5. The retail trader trap, where most get it wrong. Now, let's look at the alternative path and exactly how retail participants are about to be heavily manipulated in today's session. This is where most traders get trapped. They're blindly buying gold right now, treating it as a traditional safe haven asset just because of a news ticker regarding US-Iran headlines. In doing so, they are walking right into a massive bearish order block and unmitigated fair value gaps sitting directly overhead. Take a look at the H1 timeframe here. This highlights the false breakout zone around the 41.18 FOMC spike peak. This is exactly where smart money will likely create a trap. They'll engineer a sudden push upward into this zone to trigger retail breakout buyers, only to violently reverse price lower to sweep the true sell-side objective. Of course, we always need to protect our downside.
Our strict invalidation level for this entire bearish thesis is a daily close above 4170. If price closes above that level with volume, it completely shifts the macro narrative and we must stand aside. But until then, everything is simply a retracement within a larger institutional markdown. Section 6. Final review and recap, institutional wrap-up. Let's initiate a high-speed, precise review of the entire institutional game plan to solidify your execution for the upcoming session. To recap, our bias is firmly bearish. We wait for confirmation to enter in the key sell zone of 4075 to 4105. The macro draw on liquidity is the 3995 sell-side pool, and your strict professional risk management mandates a maximum risk of 0.5 to 0.75% on this setup. If you'd like to trade alongside these precise setups, you can find the FXTM account link in the pinned comment below to execute these strategies in a professional trading environment. The ultimate question now is whether the upcoming New York session economic data will trigger the final violent liquidity raid we're looking for, or if the trap will be sprung early. If you got value from this explainer and want to master institutional-style market analysis using ICT and smart money concepts, subscribe to ICT Market Theory. Wait for your confirmation, execute your edge, and I'll see you in the charts.